Imagine it's 1928. The music is loud, the stocks are up, and your local shoe shiner is giving you tips on how to get rich. Everyone felt like a genius. But this wasn't just a bull market, it was a margin party, and the bill was about to come due. Today, we're looking at the 1929 crash, the moment that changed how your bank account works forever. Before the crash, the roaring 20s were fueled by a brand new drug, easy credit. People were buying everything on layaway. Radios, cars, washing machines. If you couldn't afford it, the bank said, "Don't worry, pay us later." But then, the craze hit the stock market. Enter buying on margin. The ultimate infinite money glitch, or so they thought. Here's how it worked. You wanted $100 a stock? You only needed $10. The broker lent you the other $90. Simple, right? As long as the stock went up, you were a hero. You'd pay back the $90 loan and keep the massive profit. It was free money. By 1929, an estimated $600 million was lent out on margin. The entire economy was built on a foundation of IOUs. But there's a catch with margin. If the stock price drops, the broker calls. And they want their money right now. September 1929. The market gets the jitters. A few big investors start selling. The party music starts to skip. October 24th, Black Thursday. 12.9 million shares were traded in a single day. Panic starts to set in. Then came Black Tuesday. The bottom fell out. In one day, the market lost $14 billion. That's billions in 1929 dollars. The margin call happened. Brokers demanded their cash, but nobody had it. Their wealth had literally vanished into thin air. This triggered a domino effect. When people couldn't pay brokers, brokers couldn't pay banks. And then, the banks started to die. Imagine waking up, walking to your bank, and finding the doors locked. For 9,000 banks, the cash was simply gone. This was the bank run. People panicked, tried to withdraw their life savings, but the banks had lent it all to the stock gamblers. By 1933, nearly half of all U.S. banks had failed. Industrial production dropped by 47%. The party was officially over. Unemployment hit 25%. Families who were buying on margin months ago were now standing in bread lines. But from this misery, the modern world of finance was born. The government realized the Wild West of Wall Street needed a sheriff. In 1934, the SEC was created. Their job? To make sure companies don't lie to you and brokers don't gamble with your rent money. They also passed the Glass-Steagall Act, which forced a divorce between boring everyday banking and risky investment gambling. And then came the big one, the FDIC. This is why when you look at your bank app today, you see that little member FDIC logo. It means even if your bank goes bust tomorrow, the government guarantees your deposits up to $250,000. No more locked doors. We also changed the rules of the margin party. Today, you can't just put down 10%. The sheriff usually demands at least 50%. So are we safe? History says maybe. We saw echoes of 1929 in the 2008 crash, and again in the meme stock frenzy of 2021. The lesson is simple. Markets are driven by math, but they are fueled by human emotion, and humans haven't changed much. Every infinite money glitch usually ends with a margin call. The 1920s taught us that if it feels too good to be true, it probably is. If you want to understand where the next bubble is forming, you have to understand the ones that popped before. Knowledge is the only real margin. Subscribe to Penny Pulse to stay ahead of the curve. And remember, don't gamble with money you don't have. See you in the next era.